Okay, welcome to this week's edition of Compass Intelligence. As you can see, I am not Mike Simonsen. Mike is off this week, taking a pre-planned and much-deserved vacation. I will tell you right now, he is much better at recording these than I am. But this week, I'm all you've got. So my name is Dave Crosby. I'm the Chief Data and Analytics Officer here at Compass. Last Friday, Mike and I spent some time together looking at this week's data and building out some of the themes that we wanted to discuss. So I'm very excited to share those with you in this video. Last week, there were two big stories, or relatively big stories in the news as it pertains to residential real estate. First was the National Association of Realtors, NAR, released their pre-existing home sales for July. And second was reporting about the Jackson Hole event, where Federal Reserve Chairman Jerome Powell made some comments about upcoming monetary policy. We'll discuss those in a little more detail as we get into subsequent slides. They both highlight the importance of watching this data on a frequent basis. If you're new to these videos, we share various data points about the U.S. housing market every week. Our goal is to help everyone understand what's actually happening right now in the market so that they can make well-informed decisions when buying or selling a home. In these videos, we are using data that comes from Altos Research, as well as insights from what we see here at Compass, the largest real estate brokerage in the country by sales volume. Let's dive into the data for the week and the stories associated with them. Okay, so we're going to start this week by looking at pending home sales and reinforcing the importance of watching this data on a weekly basis. As I mentioned in the intro, last Thursday, the National Association of Realtors, NAR, reported July results of 4.01 million closed transactions on a seasonally adjusted annualized basis. Now, this is for previously owned homes. Those numbers represented a 2% sequential increase from June and a 0.8% increase from July of 2024. Now, for those of you who have been tuning into Mike on a regular basis, that was no surprise because what we've been watching in the weekly pending home sales is the 2025 line, which is this blue line, has been consistently tracking higher than the 2024 line, which is the purple line here. Based on what we see here for June and July, we would also expect to see very modest growth to be reported for August closed transactions when those are reported in the third week of September. However, this is really interesting to watch because if you look at July, you see that the beginning of July was tracking very, very close to 2024. And as we've come into August, we've dipped below 2024. And right now we're sitting just very, very close to the 2024 line. We're currently at 67,000 weekly pending home sales. What that means is that the numbers that are reported for September, those will be reported in late October, are likely going to struggle to show sequential year-on-year growth. This is going to be very interesting to watch as we go through the fall market and some of the decisions that are pending on monetary policy going forward. Now, I would just like to reinforce that a lot of the monthly economic data that we get is a lagging indicator of what's going on right now in the market. For example, these July closed sales, they were reported 3 weeks into August, but they actually reflect contracts that were negotiated and closed, or signed, I should say signed, during May and June. What that means is that the data that was reported by NAR carries an 8 to 12 week lag. One of, if not the most valuable aspects of Mike's weekly reporting here is that it provides a clearer picture of what's going on right now in the market, a more real-time view, if you will, into how the residential real estate market is behaving. Okay, so let's skip over here really quick to inventory. We're not going to spend a lot of time on this. The update here is that inventory ticked up just a tiny fraction. It came up 14 basis points to 861,000 single-family homes. There's another 225,000 condos in inventory right now. Since last year, inventory has been climbing pretty fast. You can see that the slope of the line has been higher or greater than 2024. But you can see here that it looks like we've plateaued. Um, this year, or this week, we're 22% higher than we were this time last year. But for a lot of 2025, we've been pacing at around 30% higher than the prior year. We might see one more week of modest inventory growth this week leading up to the Labor Day holiday. But based on what we're seeing in the data right now, it appears that inventory has temporarily plateaued. So, what other data points could tell us about what's going on with inventory growth and why it's slowing? So, we'll come over here, we'll look at new listings first. These are the weekly new listings. For most weeks in 2025, you can see that, and this is the blue line, it has tracked consistently above the purple line, which is 2024. However, coming into August right here, we've actually dipped below the 2024 number, and it appears that we're starting to flatline at around 67,000 new listings per week. That's this week, it's just 20 basis points higher than last week. We're still about 3.4% higher than a year ago. However, when we look at this behavior across the different regions in the country, we see that the new listing growth is asymmetrical. For example, when we look at states with high listing volumes, we observe year-on-year declines in California, Florida, Illinois, and New York. Offsetting those declines, we observe modest or even tepid year-on-year growth numbers in Georgia, North Carolina, Pennsylvania, Tennessee, and Texas. But even in those areas that have modest growth, as Mike mentioned last week, growth is starting to slow down. So, where are new listings growing the fastest in the country right now? Washington, D.C. The second data point we're going to look at to talk about inventory and what's going on with inventory is a new metric that Mike introduced a few weeks ago, and we've been watching this closely. It's called the seller withdrawal ratio. And this is looking at the number of listings that are withdrawing from the market as a ratio of new listings that are coming into the market. And as you can see, this ratio is trending significantly higher than prior years of 2024 and 2023. What we think this is telling us, what we think this indicates, is that this year, a much higher percentage of sellers are choosing to leave the market and wait for more favorable conditions. Based on this latest week of data, we estimate that withdrawals in August of 2025 will be between 45 and 50% of new listings, a ratio that we typically don't see until the end of the year when sellers are pulling their listings off the market for the holidays. And unlike the changes that we see in inventory and new listings, which are asymmetrical across the country, we are observing a near universal trend in higher withdrawal rates across the United States. All right, well, what's everyone waiting for then? Well, among other things, and probably one of the biggest ones, are lower mortgage rates. We did have a little bit of good news on Friday when Chairman Jerome Powell indicated that growing downside risks to the labor market, quote, may warrant adjusting our policy stance, end quote. He also simultaneously doubled down on the importance of the independence of the Federal Reserve. The Federal Reserve's Federal Open Market Committee meeting is scheduled to meet on September 16th and 17th. So that's the next scheduled opportunity for the Fed to adjust down or up, or not at all, the benchmark borrowing index rate. If they choose to reduce, there are at least two important contingencies that need to follow if we hope to see significant shift in real estate activity. First will be how the Treasury and bond market react, as those are the predicates for mortgage rates. And second will be the magnitude of the change. There's possibly a third one, which will be the probability of other rate cuts coming in the future, but that one is definitely a parlor game. As Mike previously indicated, the magic threshold that we believe shifts buyer demand is this 6% line. If we're lucky, in September, there will be enough of a policy change that starts to bring down the mortgage rates closer to this 6% threshold. If that happens, we expect inventory will start moving faster. It may even encourage some of those frustrated sellers to re-enter the market. If we're unlucky and rates stay where they are or even tick higher, it's very likely that we could start to see inventory increasing. It will definitely stagnate, but it may even start climbing after the Labor Day holiday. Okay, so we're going to end today on home prices. This chart is looking at the median price of weekly pending home sales or newly pending contracts. This week, again, we saw the median price tick down. It's now at $390,000. Additionally, if you normalize that on a per square foot basis, it's now $217. That's down 30 basis points from last week, and it's just 19 basis points higher than the same period last year. Price cuts, which Mike will also occasionally discuss in this weekly video series, appear to have leveled off at 42.1%. That means that 42.1% of listings in the market today are taking a price cut. That's 220 basis points higher than this same period last year. You take all that together, what it looks like right now, what we're observing, is that in this market, there is downward pressure on price. Oh, let's spend just a minute looking at two of these lines on the chart. We're going to look at the 2024 line and the 2022 line. We're going to look at these because of this upcoming Fed decision on rates. And these may give us a small hint or a couple hints as to what could happen depending on what the decision is and what mortgage rates do. If you recall, in last September of 2024, mortgage rates dropped to about 6% temporarily. And you can see in the data that there was an uptick in demand and price came up with it, held there through the month of October. On the other hand, in the 2022 line, which is this yellow line, in September of 2022, there was a significant increase in mortgage rates, and we saw a corresponding fall off in demand and prices followed. Given what we see today, unless mortgage rates get into that 6% range, it's very likely that future reporting will show that prices for existing home sales are falling year on year, given that this 2024 line is going to be a tough comparable. Okay, let's wrap up. Inventory appears to have temporarily plateaued. New listings also appear to have temporarily flatlined or leveled out. Sellers continue to withdraw their listings from the market at higher rates than in prior years. Weekly pending sales are slowing down and are tracking very close to 2024 levels. Prices, both median and per square foot, are just barely higher than 2024, but demonstrating a downward trajectory. Sellers appear to be increasingly hesitant to engage in the market or stay in the market. They're waiting to see how a potential Fed policy decision may impact demand. However, with inventory at 5-year highs and prices showing downward pressure, this is a great time to be a buyer in the market. Regardless of whether you're a seller or a buyer, agents and their clients should be taking advantage of every tool at their disposal to price and negotiate strategically. Next Monday is the US Labor Day holiday. We hope everyone has a safe, enjoyable, and productive holiday. Mike will be back on Tuesday with the next weekly update. Thank you and bye for now.